Welcome to The Explainer. So today we're going to get into something pretty wild, how a massive company basically decided to tear itself apart. Yeah, you heard that right. They made this huge bet that being smaller, being simpler, was actually the key to being stronger. It's a classic story, really. Focus versus scale.
And really, that leads us right to the big question here. I want you to put yourself in the boardroom for a second. What do you do? Do you build this sprawling global empire, with a finger in every pie? Or do you go all in and just become the absolute undisputed champion of your home market? That's not just a hypothetical. That was the exact choice facing a company called Old Mutual. All right, let's get right into it. To really wrap our heads around this decision, we've got to talk about the company at the heart of it all, Old Mutual. See, they had this problem, a really classic problem, actually. They were huge, but being big just wasn't making them valuable in the eyes of the market.
So who is Old Mutual? Well, today, they're an absolute powerhouse in African financial services. I mean, especially in South Africa, they've got this dominant chunk of the life insurance market. But, see that word formerly? That's the key. Because before all this happened, Old Mutual was a completely different beast. It was this massive, sprawling, global company based out of London.
And look, we're talking about a company with a market cap of around $3.8 billion. So yeah, obviously a valuable company. But here was the issue, the thing that was probably keeping the board up at night. The market, it just kept saying, hey, all your individual businesses are great, but when you put them all together, the whole is actually worth less than the sum of its parts. Weird, right? And that right there gets to the absolute heart of the problem. It's a textbook case of something called the conglomerate discount. Basically, investors were looking at Old Mutual and thinking, man, this thing is just too complex, it's too inefficient, and because of that, they were literally punishing the stock price. We're talking by like 15 to 20%, just because it was trying to do too much in too many different places. So, okay, something had to give. This wasn't a problem you could just ignore. And that led them to this incredibly bold solution. They called it managed separation. And this wasn't some minor course correction. No. This was a plan to literally dismantle their own empire. Now, an undertaking like this, it's not something you do overnight. This wasn't a quick fix. Just look at the timeline here. It was this very deliberate, multi-year journey. It kicked off back in 2016 and didn't really wrap up until 2021. Every single step had to be carefully planned and rolled out. When you boil it all down, the whole strategy really came down to three huge, massive decisions. Step 1, break up the global conglomerate. Step 2, pivot the whole company to focus laser-like on Africa. And Step 3, unbundle their massive banking business, Nedbank. Let's take a look at each of these moves. Okay, so first up, the breakup. What they did was they took that big parent company in London and just split it into 4 totally separate independent businesses. The whole point was to kill that conglomerate discount we talked about, right? And also to escape these complex European rules that were just tying up their money. And the impact, it was immediate and it was huge. They saved something like £130 million a year just from getting rid of the big head office. Decision number 2 was a huge bet on their home turf. They actually moved their primary stock listing from the London Stock Exchange all the way to Johannesburg. And their reasoning was pretty straightforward. They were convinced the real growth was in Africa, not in those older, more mature Western markets. Now, this was great for aligning the company with its main customers, but it also meant they were tying their entire future to the ups and downs of the South African economy. And finally, the third big move, unbundling Nedbank. See, the market was heading them with this kind of double discount. They were getting penalized for being a complex conglomerate, and they were getting penalized on their ownership of this big bank. So they said fine, and basically just gave most of the bank away. They handed out the shares directly to their own shareholders. And just that one move, it unlocked something like $2.4 billion in value. Plus, it finally let investors look at the insurance business and the banking business on their own terms. So there you have it. The plan is done, the empire is dismantled, the company has a brand new focus. But what happens next? What were the real consequences of such a dramatic shift? Did it actually solve all their problems, or did it just swap one set of problems for another? And this is where it gets really, really interesting, because it's all about the trade-off. Think about it. They went from being this diversified global company to a super-focused African champion. On one hand, yes, they solved the whole complexity and inefficiency problem. But on the other hand, they gave up this really important safety net, their hedge against currency swings, and left themselves totally exposed to the political and economic risks of just one single region. You know, this quote here, it just says it all, doesn't it? It perfectly sums up the thinking behind this entire massive project. They made a very deliberate choice. We want to be masters of one thing, not just a player in many. And here's the punchline of that whole trade-off. The market, it stopped punishing Old Mutual for being too complicated. Great, but it just started applying a new kind of discount, this time for sovereign risk, basically all the risks that come with being tied to one country, South Africa. In essence, they just swapped one discount for another. Which, of course, brings us to the big final question, the one everyone wants to know. After all of that work, after tearing down a global giant and rebuilding it from scratch, did it actually pay off? Was it a success? Well, if you look at the scorecard, the answer is it's complicated. It's not a clear yes or no. In the win column, you've got some huge positives. A much simpler company, massive cost savings, and a big chunk of capital handed right back to shareholders. But in the loss column, you have the loss of that global diversification, the new exposure to South African risk, and giving up those steady, predictable earnings from the bank. So that big pop in the stock price they were probably hoping for, it never really happened. It wasn't a knockout punch. But that's not the end of the story. More recently, there are signs that investors are starting to come around, that they're slowly buying into this new, leaner, more focused company, which means the final verdict, well, it's still very much up for debate. And this really raises a critical question for anyone studying this kind of corporate strategy. Think about it. They sold off their stable businesses in the US and the UK, the ones that earned in dollars and pounds. Were those their lifeboats? And did they sell them right before sailing headfirst into the sometimes choppy waters of an emerging market? So now it's over to you. We've seen the problem they were facing, we've seen the radical three-part plan to fix it, and we've seen the pretty mixed results. So what do you think? Was this a bold, necessary step forward? A modern evolution? Or was it more of a strategic retreat, where they gave up stability for huge, risky bet on growth? It really is a classic business dilemma, isn't it? At what point does that intense focus you're striving for actually become your biggest liability?